Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Alkaline Water Company stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. The Alkaline Water Company's flagship product is a water called Alkaline 88. The number 88 comes from the pH. Their pH is 8.8. A water can be called alkaline if its pH is above 7. It also has flavored waters and CBD infused waters. The company is headquartered in Scottsdale, Arizona and was founded in 2011. It went public in 2013 and trades on the Nasdaq, Canadian Stock Exchange, and Deutsche Börse. It also sells powders, gummies, and topical creams. But it's recently expanded into Mexico and it's likely to get into Canada this year or next. It's in over 50,000 retail locations in the US, and it's the 10th largest enhanced water brand in the country. You could find this product in Safeway, Albertsons, Walmart, CVS, Whole Foods, and many more stores. Basketball Hall of Famer Shaquille O'Neal joined the company as an equity partner and member of the company's board of advisors. The more celebrities the company has on its team, the more visibility its products will receive. This is a really tough space to grow, so they're going to have to spend a lot of money on marketing. The alkaline water category sales are projected to be $1 billion next year and over $1.2 billion by 2024. This is a big industry with a lot of opportunity for existing brands and up-and-coming companies like this one. This company may become an acquisition target if it keeps growing. Large companies like Coca-Cola have acquired brands to get into the healthy water space. It acquired Vitamin Water, Fuse, and Tropico. Vitamin Water was the largest specialty water acquisition ever at $4.2 billion. This is an article from the Mayo Clinic website. Alkaline water has added nutrients to achieve an alkaline pH. Scientists use pH to describe how acidic a substance is on a scale of 0 to 14. A substance is alkaline if its pH is over 7. This company is 8.8. Because alkaline water has a higher pH than plain tap water, however, research suggests that alkaline water is unlikely to significantly change blood pH. Studies suggest that alkaline water might help slow bone loss, but it's not clear if this will be maintained over the long term. Some say that alkaline water can help prevent disease such as cancer and heart disease, but there's not much evidence to support this claim. Let's get started with the model. This is a micro-cap company, 137 million market cap. They're trading at $153 a share, and they have 90 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have negative free cash flow every year, because they're still trying to grow their brand, so they're investing a lot back into their business. Net income is a profit or loss on the income statement. It's revenue minus expenses. That's also negative every year. Revenue is the sales for the company, and that more than doubled from 2018 to 2020. Then it grew a little more in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's more than doubled from 2018 to 2020. It's even higher in the trailing 12 months. Below that is operating expenses, and they're spending a lot on marketing because they need to really separate themselves from the pack, because this is a really difficult industry to stand out. And as you can see, they have higher operating expenses than gross profit, so they have negative operating income every year. Below that is the interest they pay in their debt. They paid about $600,000 of interest in the trailing 12 months. And the bottom line of the income statement is their net income, which is negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So they are leaking cash flow each year because they're still aggressively growing their brand. They don't have too much in CapEx each year because they're outsourcing to co-packers. The co-packers make the water, bottle it, and ship it out. This takes a lot off the company's plate so they could focus on growth. Operating cash flow minus capex gives you your free cash flow, and of course that's negative every year. But I do expect when they hit about 100 million of revenue, they'll probably have positive operating cash flow. They're mostly using capital stock to fund their business. They issued 17 million in 2019 and 5 million in the trailing 12 months. When a company uses capital stock, it increases the shares outstanding, making your shares less valuable. So it dilutes your investment. They issue some debt, 1.7 million in 2018, $500,000 in 2019, and 4 million in 2020. They also have been paying down some debt as well. They paid down 3 million in the trailing 12 months. When a company has negative operating cash flow, they should really fund their business with capital stock. Because if they fund it with debt, they have to pay the interest payments on the debt. Since they have negative operating cash flow, they need to take on more debt to pay the interest on their old debt. So it's kind of like a debt snowball. It gets bigger and bigger. Let's look at the capital structure. They have 2 million of equity, 5 million of debt. They're 1/4 equity, 3/4 debt. And their WACC is 11.75%. The weighted average cost of capital is a blend of the cost of equity and cost of debt. And that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 7, that's 900 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $459 million. We divide that by 90 million shares. And we get a calculated stock price of $5.11. They're trading at $153, so they're trading at a 70% discount. It's a really strong buy according to the model. So it's really hard to value a company that has negative free cash flow that's in growth mode. So the way I valued them is I estimated their revenue will be about $800 million by 2027, which I think is definitely reasonable. And they would convert 10% of that into free cash flow. And then the prior free cash flow is just backed into that $80 million. But I think there's a better chance of them getting acquired by Pepsi or Coke in 2023, 4, or 5. When a company gets acquired, the acquiring company tends to pay a premium. So if one of the big companies even mentioned its intention to acquire this company, Water's stock would probably go up 50% right away. 3 analysts priced this stock and 2 rated a strong buy, 1 a buy. Their average price target is 308, so everybody's saying this stock is undervalued. It does appear the stock IPO'd at $25 a share from this chart. This is the stock price since it started trading in 2013. Also in 2013, they did a 15-for-1 stock split. But if I said anything incorrect, let me know in the comments. I try to look through as many of their reports as possible to get information on this. It appears they did the 15-for-1 stock split because they were merging with another company. But once again, I'm not really sure why they did the stock split. Most companies do a stock split because their stock price is too high, like several $100s a share, and they want to bring the stock price down so more people can afford it. But this company's stock price wasn't high. This is where the stock has been trading the past 52 weeks. It did dip below $1 at one point, and it traded at $2.60 at its highest point. Right now it's trading at $1.53. So the good thing is the company is bringing in revenue. Their fundamentals aren't weak. They're just not profitable at this point because they're sacrificing net income to grow the brand. This looks like a really good opportunity to get in on a stock before it blows up. And they have a pretty high beta, 1.92, so the stock moves about 2 times the market. The stock has gone down 8% in the past 52 weeks. You would have been better off investing in the S&P 500, which went up 37%. The 52-week low is 93 cents, the high was 260. And the stock is trading above its 50-day and 200-day moving average. About 1.5 million shares are traded each day on this stock. Of the 90 million shares outstanding, 72 million are on float. The other 17 million are held by insiders. 5% of the shares are held by institutions and 3% are shorted. The stock is down in the past year, 3 years, and 5 years, while its industry and the market are up in the same periods. But in the past 30 days and 90 days, this stock has performed really well. Analysts are bullish on this company. They're expecting their earnings to grow 73%, and they're expecting their revenue to grow 35%. Much better than its industry and the market. In the past 5 years, their annual earnings decreased 23%. Last year, its earnings decreased 15%. That's only because they have negative earnings, so the numbers are pretty volatile at this point. its industry and the market have increased in the same periods. If you invested $10,000 into this company when it IPO'd, you would have tripled your money. You'd be at almost $30,000 today. That's a 15% annual return. The CEO of the company owns 4.3% of the stock, then Vanguard, then the CFO, then Geode, then Pasonic Partners. Let's look at their financial ratios. They have negative net income, so we can't look at the PE. They do have a good price to sales ratio, 2.9. That's close to the market median. So they are bringing in a good amount of sales relative to their market cap. They have a bad price to book because they only have $2 million of equity. Equity is on the balance sheet. It's assets minus liabilities. It's the value of the company according to the balance sheet. They have negative operating income, so they have negative return on invested capital, negative interest coverage ratio, and negative ROE. They can cover their current liabilities with their current assets, and their current assets are $1.7 million of cash, $5 million of receivables, and $4 million of inventory. They do seem to be undercapitalized. They had negative $15 million of free cash flow in the trailing 12 months and $1 million of working capital, so they're short $14 million. So they're going to need more equity financing or more debt financing to fund their operations in the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 5 other companies in the same industry as water. And if water has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're pretty much worse in every single ratio except price to sales. They are a young company, still growing their brand, so they don't have good ratios. So to summarize, I have them trading at a 70% discount. But this company seems to be doing well. Even though $47 million might not seem like a lot of revenue, you can't even buy one Boeing airplane for that price, but you can buy a ton of water for that price. Plus they got Shaquille O'Neal on their board. And if they could get more celebrities, they can really separate themselves, because that's really the key, is to stand out from the crowd. And as more and more people try to get healthy, this infused water craze may be the next big thing. Even if there's not any proven health benefits, perception is more important than reality. I rank their free cash flow as 1 out of 10, their revenue 5 out of 10, and their ratio is 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.